average are trading at 12 times earnings and yielding close to 3%. So you can get a 3% dividend yield, and you know the dividend's money good, and none of those companies are going to cut the dividend. So you're guaranteed to get 3% a year for the next 10 years just on the current stock price. All three. So if you get inflation, all of these companies have pricing power, so you'd figure they can pass along inflation. So I think short of a severe Japan-style deflation, which there's maybe a 5 or 10% chance of that over the next 10 years, you're overwhelmingly likely to do better in carefully chosen blue chip equities with a nice dividend yield where you're not paying too high a multiple for it. Yet the institutional investors of the world are fleeing to 2% treasuries.
Now, you try to do well, obviously, long term.
Sure.
Is this one of your worst years ever still, or things are picking up?
It is. It's
worst year in 13 years.
It's our this will be our third year out of 13 that we've trailed the market, and we're down over 20% this year, which has been painful and humbling. And it's the kind of thing where I wish you hadn't reminded me of it, because actually to succeed when you're in a hole, and every investor goes through periods where you just have the touch of dirt. I'll call it the polite word. We'll call it the touch of dirt. Investing is a probabilistic business, and every once in a while it's sort of like you're throwing dice, and anything. Let's say you're throwing a 6-sided dice, and anything except a 1 or a 2, you're doing well. Well, statistically speaking, you throw the dice enough times, you're going to throw a 1 or a 2 5 times in a row, and you're going to look pretty foolish, right? So I think that's mostly what's happened to us over the past year. And so there's been no single mistake. We didn't pile into financials earlier this year and get killed on that or anything like that. It's just sort of been across the board. The playbook that's worked well for us for 12 years just hasn't been working for us. So it's been sort of frustrating and humbling. But the key actually when you're in a hole is you have to mentally pretend that you're flat on the year and that your portfolio is 100% cash. What would you do? Because what really gets you into trouble is when you're in a hole and it's so painful and your investors are mad at you and so forth that you swing for the fences and you start taking on leverage and buying riskier securities in an attempt to quickly get back out of that hole, right? And you have to wipe your mind of the fact that you're down and feeling bad about it, and you just have to approach every day and say, if I were starting fresh today, what would my portfolio look like? And so that's how we think about it.
How do you deal with clients? Because their record, like the proverbial individual, is if you're on a hot streak, they like you.
Sure.
If you have a few bad years, even though you've had a good long-term record under discipline, you're not flying all over the place, they abandon you. Whereas research shows it's precisely when you have a cold hand is when a client should come in.
Right. Well, as you said, the best time to buy a good company is when it's hit a short-term rough patch and the stock's gotten clobbered, and that's the very self-serving argument, admittedly, that we make to our clients, that, hey, judge us based on our 13-year record, and it's a pretty darn good record. We basically more than doubled our investors' money net to investors, in basically a flat market over almost 13 years. So we have still, even after this year's terrible performance, we have a good long-term record. But the key is we built our business the right way. We never went after hot money, fund-to-funds, etc. Our investors are generally upper middle income to high net worth individuals who are investing their own money. And they're people that we communicate with regularly. A lot of our money is just friends and family. And so we built our business deliberately to make sure we could withstand a period of poor performance, because we knew that every investor goes through periods of poor performance, and you want to make sure that you can play a strong hand and not be forced to sell cheap stocks, but instead can be buying them. So the good news is we're still standing strong. We're not being forced to sell anything, and we're at very minimal redemptions. It would be hard for me to think of any fund I know of out there that would have as bad a year as we're having, that would have as few redemptions as we're having. And that's, I think, because testament to our investors and how we built our business.